Stocks, meantime, tumbling into the close. The major averages closing at their lows of the day. This morning, BTIG's Jonathan Krinsky put out a new note saying stocks could be at a turning point, and maybe today was going to be the deciding factor. He joins us now on the CNBC Newsline. It's good to have you. So what were you alluding to when you put this note out, talking about today specifically?
Hey, thanks, Scott. So there's two aspects here. The first, we know over the last few weeks there's been a lot of key macro data points, and during a lot of those, early weakness was bought throughout the session. And so this morning we thought it felt a little different. Now they did obviously buy it in the morning, and then that reversed into the close. But the second point, we put out a secondary note this afternoon, is the fact that throughout this multi-week period, there's been this growing divergence between interest rates and stocks, where, we know that interest rates have kind of surged back to the upside, and stocks, by and large, have been ignoring that. But what we notice is that over the last 18 months, there's actually been a pretty consistent lead time between when rates, whether it's real or nominal, start to move up and when equities start to falter. So pretty much every time over the last 18 months, there's been kind of this 1 to 4 week lead time. And so we know that real rates bottomed January 25th. So far, the market peaked February 2nd or so. So whether we make a marginal new recovery high or not, it's not atypical to see this kind of multi-week lead between rates and stocks. So we think the move in rates is telling that stocks should begin to resume their downward trend here.
What I find so interesting as you talk about that divergence, and that's the word that you used, it goes to our argument or debate at the top of the show, which is raging in the market now. Don't fight the Fed versus don't fight the tape. You are trained as a technician not to fight the tape, right? I mean, that's the very pedigree and the core of what you do. So how do you reconcile that debate right now when the market seems to be telling you something despite what the Fed is saying and what the fundamentals may suggest?
Yeah, I mean, look, there's two parts to kind of how we view things. There's the pure price action in a vacuum, and there's the kind of taking the weight of the evidence approach. And one of the other things we've been pretty adamant about is that the entire market action over the last 18 months has really been predicated on the direction of the dollar as well. And we know that the dollar peaked last September, equities bottomed shortly thereafter, and, the entire rally since October has been in the face of a weaker dollar. So, from our perspective, we don't think we can get a true sense of the sustainability of this rally until we see stocks act strong in the face of a stronger dollar. And again, so far the dollar bottomed February 2nd. So far the market peaked February 2nd. So, there's a lot of cross currents. We will 100% admit that the durability of the market has been, more positive than we would have expected. But again, it's not atypical to see a bit of a lag effect. When you see rates move up, don't be surprised if equities, move down in the subsequent weeks after. And that's what has been consistent over the last 18 months.
I feel like, I know that you were initially pointing to today, but I feel like tomorrow is now set up as an extraordinarily critical moment for the rally. The S&P closes, 40.90? 200-day moving average is 40.88. So you got 2 points to go here. We haven't closed below the 200-day moving average for a while, right? So how closely are you watching that line? And if we do breach it and close below it, what does that mean?
Yeah, I mean, that's another counterpoint to the bearish argument, is that we've spent a lot of time above the 200-day. I think if you were to go back and look historically, you don't tend to spend that much time above the 200-day within bear markets, but that evidence goes back to about 1950. If you go back pre-1950, there was actually quite a bit of times where the market did spend a lot of time above the 200-day and then went on to make new lows. The last thing we'd highlight is that despite all the wild gyrations, the market this week has traded entirely within the range of last week's market, and last week's market traded entirely within the range of the week before that. So we've now gone 3 weeks essentially sideways. And to your point, I think it'll be an interesting close tomorrow. And then into next week, there's typically some weakness post-February options expiration, and it kind of seems like the market's set up for a bit of a hangover after all this, buying weakness off of these key macro data points.